Welcome back to Abhik Parth. Today, we'll explore Chapter 3 of the Little Book of Common Sense Investing by John C. Bogle, Cast Your Lot with Business. This chapter emphasizes the importance of trusting long-term business growth through index funds rather than short-term market speculation. To make it easy to understand, I'll also share some practical, real-life examples. Let's dive in. Let's start with the central idea. When you invest in an index fund, you are not just buying stocks, you are buying ownership in real, profit-making businesses. Over time, these businesses grow, generate profits, and deliver returns to their shareholders. That's how wealth is created in the stock market. But here's where many people go wrong. Instead of focusing on long-term business growth, they try to predict short-term market movements, which leads to poor decisions and lower returns. Key Lesson 1: Long-term wealth through business growth. To understand this, let me give you a practical example. Example 1: Investing in the S&P 500 index. Imagine you invested $1,000 in the S&P 500 index 30 years ago. At that time, the index represented 500 of the largest companies in the United States. Over 3 decades, these companies grew their revenues, launched new products, and entered new markets. Today, that $1,000 investment could be worth over $15,000 or more, depending on the exact time period, just by staying invested and letting the businesses grow. You didn't have to pick individual stocks or predict market trends. All you did was trust the power of business growth and let time do its magic. Key Lesson 2: Avoid speculation. Bogle warns against the dangers of speculation, trying to time the market or predict short-term price movements. Let me explain this with another example. Example 2: Ramesh versus Suresh. Ramesh invests 10,000 rupees every year in an index fund and holds his investments for 20 years. Suresh, on the other hand, tries to time the market. He buys stocks when he thinks the market will rise and sells when he expects a fall. At the end of 20 years, Ramesh's steady investments in the index fund will likely have grown significantly because he benefited from the power of compounding and the consistent growth of businesses in the economy. Suresh, however, might have underperformed due to trading fees and taxes, emotional decisions during market volatility, missing out on major market rallies. The result? Ramesh builds wealth steadily, while Suresh struggles to achieve the same returns. Key Lesson 3: Why index funds work best. Now let's consider the difference between investing in index funds versus actively managed funds. Example 3: Low-cost index funds versus active funds. Imagine 2 investors. Investor A chooses an index fund with an annual fee of 0.10%. Investor B chooses an actively managed fund with a fee of 1.5%. Both invest 1 lakh rupees for 30 years with an average annual return of 8%. Investor A's index fund. After 30 years, their investment grows to 10 lakhs 80,000 rupees. After fees. Investor B's active fund. Due to high fees, their investment only grows to 8 lakhs 90,000 rupees. That's a difference of almost 2 lakhs rupees, just because of lower fees in the index fund. Key takeaway: long-term patience pays off. Investing is like planting a tree. You don't keep digging it up every day to check if it's growing. Instead, you water it, provide sunlight, and let nature take its course. Index funds work the same way. Your investments grow over time as businesses flourish. Bogle's advice is simple. Cast your lot with business by investing in low-cost index funds, avoid speculation, and stay invested for the long haul. To sum it up, Chapter 3 teaches us that the best way to build wealth is by trusting in the long-term growth of businesses through index funds. Avoid the pitfalls of speculation and focus on the steady, reliable growth of the market. What are your thoughts on this approach? Have you started your index fund journey yet? Let me know in the comments. And don't forget to like, share, and subscribe to Abhik Parth for more financial insights from this incredible book. Movie Camera, watch the full playlist below. Glowing Star, follow me on LinkedIn, Twitter, and Facebook for updates and more financial wisdom. Bell, hit the bell icon to never miss a chapter. Welcome back to Abhik Parth. Today, we'll dive into Chapter 4 of the Little Book of Common Sense Investing by John C. Bogle. This chapter reveals a harsh truth: most investors unintentionally sabotage their own success. Why? They turn what should be a winner's game, investing in the market, into a loser's game by making common mistakes. Let's unpack this concept with real-world examples and practical insights. Investing is simple, but not easy. The stock market itself is designed to grow over time. However, many investors end up losing money because of their behavior, not because of the market. Bogle explains that most investors fall into traps like excessive trading, chasing performance, and paying high fees. Let's explore how these mistakes turn a winning strategy into a losing one, and how you can avoid them. Key Lesson 1: The costs of frequent trading. Frequent trading is one of the biggest reasons why investors fail. Instead of buying and holding for the long term, many people jump in and out of the market, trying to time their trades. Example 1: Ravi's trading frenzy. Ravi hears about a hot stock dip and invests 1 lakh rupees. A month later, he sells it for a small profit of 5,000 rupees. Encouraged by this, he keeps trading regularly. However, he doesn't account for brokerage fees, taxes on short-term capital gains, losses from bad trades. At the end of the year, Ravi realizes that his profits were wiped out by the costs of trading, leaving him with less money than if he had simply invested in an index fund and held it. Key Lesson 2: Chasing past performance. Many investors choose funds or stocks based on their recent performance, assuming the past guarantees the future. Bogle warns that this approach rarely works because markets are unpredictable. Example 2: Neha's fund dilemma. Neha invests in a mutual fund that delivered 30% returns last year. She's convinced it will perform well again, so she pours her money into it. The next year, the market crashes, and the fund loses 20%. What Neha didn't realize is that last year's top-performing funds often failed to maintain their streak. By chasing past performance, she ignored the fundamentals and paid the price. Key Lesson 3: High fees eat into returns. Investing is a winner's game when you minimize costs. High fees, however, turn it into a loser's game. Example 3: Low-cost index fund versus high-cost active fund. Imagine 2 investors. Investor A chooses a low-cost index fund with an expense ratio of 0.10%. Investor B invests in a high-cost actively managed fund with a fee of 1.5%. Over 30 years, with a 5 lakhs rupee investment growing at 8% annually. Investor A earns 50 lakhs rupee after fees. Investor B earns only 38 lakhs rupee due to high fees. That's a difference of 12 lakhs rupees. Bogle reminds us that keeping costs low is one of the simplest ways to maximize your returns. Key Lesson 4. Emotional decisions harm your wealth. Fear and greed are powerful emotions that lead investors to buy high and sell low, exactly the opposite of what they should do. Example 4. Market crash panic. During a market crash, Ajay sees his portfolio value drop by 30%. Panicked, he sells all his investments to avoid further losses. However, 6 months later, the market recovers, and Ajay misses out on the rebound. If Ajay had stayed calm and held on to his investments, he would have regained his losses and earned even more in the long run. To sum up, Chapter 4 teaches us to avoid common investor pitfalls: excessive trading, chasing past performance, paying high fees, and making emotional decisions. Remember, the market itself is a winner's game, but only if you play it wisely. Keep your costs low, stay patient, and focus on long-term growth. What's the biggest investing mistake you've made? Share your story in the comments below. And if you found value in this lesson, don't forget to like, share, and subscribe to Abhik Parth. Movie Camera. Catch the full playlist below. Glowing Star. Follow me on LinkedIn, Twitter, and Facebook for more updates and financial tips. Hit the bell icon to stay notified about the next chapter.